Welcome back to Canada Accounting Insights. Today, let's talk about long-term financial liabilities, bonds, notes, and loans that stretch far beyond the next 12 months. These aren't just numbers on a balance sheet. They tell the story of how companies finance growth, manage risk, and communicate financial health to investors. So in today's video, we're breaking down everything you need to know, from initial measurement to derecognition, from amortized cost to fair value, and finally, how IFRS and ASPE treat these liabilities differently. Before we dive in, don't forget to like this video, subscribe, and hit the bell. It really helps support the channel and keeps great accounting content coming your way. All right, let's start with the basics. When companies need funds for expansion or big investments, they often borrow money that won't be repaid within the next year. That's what we call a long-term financial liability. According to IAS 32, a financial liability is a contractual obligation to deliver cash or another financial asset to another entity. So the key takeaway here is that the obligation must be contractual, and it must involve future payment, typically in cash. These include bonds payable, notes payable, and long-term bank loans. But for simplicity, we'll focus mainly on bonds today, since they capture all the core concepts you'll need to understand the rest. And speaking of bonds, let's see what they're all about. A bond is simply a promise. The issuer agrees to repay the face value at a future date and make periodic interest payments along the way. Now, why issue bonds instead of shares? Here are 3 big reasons. Issuing bonds doesn't dilute ownership, interest expense is tax deductible, and earnings per share usually stay higher because no new shares are issued. Bonds can be secured, backed by collateral. Unsecured, also called debentures, or include features like callable, retractable, or convertible options. And just like stocks, bonds trade on markets. So when you hear that a bond is trading at 98.5, it means it's priced at 98.5% of its face value. Now that you know what bonds are, let's move on to how we measure and record them. Under IFRS 9, financial liabilities are initially classified as either at amortized cost or at fair value through profit or loss, FVPL. Most long-term liabilities are measured at amortized cost, unless a company chooses FVPL to eliminate accounting mismatches. So let's start with amortized cost. At initial recognition, bonds are recorded at fair value minus transaction costs. For example, Greenfield Apparel issues a $1 million 10-year bond with a 5% interest rate, payable semi-annually. The company incurs $30,000 in legal and financing fees. The carrying value starts at $970,000, the net proceeds. Now let's talk about how the bond price itself is determined. Here's the rule. When the coupon rate equals the market rate, the bond issues at par. If the market rate is higher, it sells at a discount. If the market rate is lower, it sells at a premium. For example, Summit Construction Corp. issues a $100,000 5-year bond with a 5% coupon rate, payable semi-annually, but the market demands 6%. The bond will sell below face value, around $95,735, since investors want a higher yield. Step 1. We determine semi-annual data. Then Step 2. We calculate the present value. As you can see, bond prices move inversely to interest rates. When rates go up, prices drop, and vice versa. Now let's apply this to real accounting entries. Discounts and premiums are just reflections of market conditions. Let's look at both scenarios. Discount example. North Point Energy Inc. issues $2.5 million bonds at 6% interest when the market rate is 7%. Interest is paid semi-annually for 5 years and issuance costs $100,000. Present value is $2,396,042. Step 1, we compute bond price. Then Step 2, we subtract issuance costs and do the journal entry of $2,296,042. The second scenario is a premium example. Lakeside Equipment issues the same $2.5 million bonds, but this time at 7% interest when the market rate is only 6%, interest is paid semi-annually for 5 years, and issuance costs equals $100,000. Present value equals $2,606,628. Step 1, we compute bond price. Then Step 2, we subtract issuance costs and do the journal entry. Whether it's a discount or a premium, the idea is the same. You adjust the bond's carrying value so that it equals its fair value at issuance. Now let's look at what happens when bonds are issued mid-period. Sometimes companies issue bonds between coupon payment dates. In those cases, investors prepay the accrued interest because they'll still receive the full coupon on the next payment date. For example, Aurora Manufacturing Limited issues $1 million of bonds on May 1st, dated January 1st, with an 8% annual coupon paid semi-annually. We compute accrued interest of $26,667 and then do the journal entry. At the next interest payment, the issuer only records interest expense for the time the bond was actually outstanding. Speaking of other classifications, let's talk about bonds at fair value through profit or loss. For bonds classified at FVPL, everything revolves around fair value. They're measured at fair value initially and at each reporting date, with any changes going directly to profit or loss. Example, Orion Tech Systems Limited issues a $500,000 5-year bond at par with a 4% coupon, incurring $25,000 in issuance costs. In this classification, there's no need to amortize discounts or premiums. All adjustments flow through the income statement as fair value changes. Now, let's explore what happens when debt isn't issued for cash. Sometimes companies issue notes payable to acquire assets instead of paying cash. In this case, the liability is measured at the fair value of the asset received. Example, Harvest Ridge Developments Limited issues a zero-interest note for $400,000 in exchange for land valued at $320,000. Once issued, these liabilities are then measured over time. Let's see how that works. After initial recognition, long-term liabilities are remeasured based on their classification, either amortized cost or FVPL. At amortized cost, the effective interest method is used here. This means you recognize interest expense based on the carrying value multiplied by the effective interest rate. Discounts gradually increase the liability, premiums gradually decrease it. Here is an example of discount. Polar Industries issued $2.5 million at 6% when the effective rate was 7%. Each period, interest expense exceeds the cash paid, and the difference increases bonds payable. Example of premium, Ironclad Investments issued $2.5 million bonds at a premium with an effective rate lower than the coupon. Over time, interest expense is less than cash paid, reducing the bond's carrying value until maturity. For fair value profit or loss liabilities, there's no amortization. They're revalued at each reporting date, and any changes in fair value are recorded as gains or losses in profit or loss. Now that we know how to measure them, let's see how they're removed from the books. A liability is derecognized when it's settled, canceled, or expires. This might happen when the company pays the debt at maturity, repurchases it in the market, or exercises a call option to buy it back early. Simple, right? Now let's look at special cases like defeasance and debt modification. Defeasance occurs when a company sets aside enough assets, like cash, in a trust to pay off a loan at maturity, and the loan agreement releases them from the obligation. In that case, the debt is derecognized. If the terms of a loan change substantially, say the discounted present value differs by at least 10%, this is treated as a new liability. The old one is derecognized and the new one recorded at fair value. Next, let's move from recognition to presentation, how this appears on financial statements. Under IAS 1, liabilities are classified as current or non-current. Current portions, due within 12 months, are separated from long-term portions. For liabilities measured at FVPL, they're usually presented as current liabilities. In terms of disclosures, companies must present gains or losses on liabilities, interest expense using the effective interest method, and carrying amounts and fair values of each class of liability. Now let's expand beyond bonds, because other long-term liabilities follow similar logic. Notes payable and long-term bank loans are treated just like bonds, except they aren't traded publicly. They're recorded at fair value less transaction costs, and interest is recognized using the effective interest method. For example, Evergreen Transport issues a 4-year, 5% note payable for $50,000 cash with $7,000 in issuance costs. The journal entry is debit cash $43,000, credit notes payable $43,000. Because of the reduced proceeds, the effective interest rate ends up being higher than 5%. Sometimes these loans accrue interest daily. Let's see how that works. In real life, interest isn't always annual. It's usually calculated daily. For example, Harborview Motors issues a 6% 3-year $100,000 note on December 1st. By December 31st, it owes 1 month of interest. Interest equals $100,000 times 6% times 31 over 365 equals $510. All right, now let's compare IFRS and ASPE. Under IFRS, discounts and premiums must be amortized using the effective interest method. Under ASPE, Section 3856, companies can use either the effective interest method or the simpler straight-line method. And IFRS requires far more detailed disclosures than ASPE does. For example, Brightview issues a $1 million bond with an 8% annual coupon for $950,000, a $50,000 discount. 10 semi-annual payments amortize $5,000 each time. The journal entry for each payment would be debit interest expense $45,000, credit cash $40,000, credit bonds payable $5,000. Same idea applies for premiums. You'd amortize evenly in the opposite direction. Now let's wrap everything up with this example. Henderson Manufacturing Limited issues $5 million 10-year bonds at $5,159,133, meaning a premium. Interest rate 10% payable semi-annually. Under IFRS, these bonds would be recorded at amortized cost and the premium amortized using the effective interest method. Under ASPE, the same company could choose to amortize the premium evenly using the straight-line method instead. Different approach, same concept, recognizing interest and adjusting carrying value over time. So let's recap what we covered. Initial recognition. Fair value plus or minus transaction costs. Subsequent measurement, amortized cost or FVPL, derecognition. When the obligation is settled or canceled, IFRS versus ASPE, the key difference lies in the amortization method and disclosure detail. If this helped clarify long-term financial liabilities, drop a like, subscribe, and share this with a fellow CPA candidate or accounting student. And remember, accounting isn't just about memorizing standards, it's about understanding the story behind the numbers. Thanks for watching Canada Accounting Insights, and I'll see you in the next video.